All right, we have the TikTok live and the YouTube live running at the same time. We're going to wait a couple of moments here before we get this global macro update started. I do not want to install that right now. And looks like we got a couple people on TikTok here. And I've already messaged people on our Discord page, on the general chat. Hey everyone, I will be going live in today's global macro update on YouTube as well as TikTok. But usually, if you are interested in actually learning about it and actually wanting to get some value from the global macro updates, I would definitely suggest going on our YouTube if possible. So we got a couple of people on here, so I think we're going to get started here. Hello, Truck Nubs. Welcome to another update. This one's a global macro. We'll be going over some coronavirus stuff really quickly. I know that it's not really fun to touch on. Going over a potential stimulus package that the Fed is now going to have in late April or mid-May, and then going over some other things as well. So let's get started with our video. We're just going to hit the record button here. Hello traders, welcome to another global macro update. In this video, we're going to go over some key news stories that are going to be shifting the markets and things that could be influencing gold, silver, S&P, as well as just information on the COVID spread, and then kind of more longer term looking at how this is going to impact the psychology of kind of the entire generation that is currently getting affected by it. So without further ado, let's just bring this over. And quickly going to talk about the spread here. A huge jump. We got over 1.3 million people now with total confirmed cases. Almost reaching up to 100,000 deaths here, which is obviously very negative and catastrophic. Italy's leading at 16,500. US is leading in terms of the confirmed cases by far with over 350,000. So definitely stay safe, stay indoors, wash your hands, all that stuff. I'm sure you are well aware of how you can help not only yourself, but the community around you. So yeah, not going to touch on this too much more. Just wanted to quickly go over the numbers. So this is going to be the Phase 4, another stimulus package. Let's read right into it. Phase 4 coronavirus package could pass Congress between late April and mid-May, analysts say. And I'm just moving to TikTok here because last time I did get a copyright infringement or something along the lines of that. So let's continue reading. As Washington works on its fourth legislative response to the coronavirus crisis, analysts are predicting that the next big spending deal isn't likely to be coming in a reality for weeks. So it's not happening right away, but is still in the works. The next bill is no longer sparking talk about huge outlays on infrastructure improvements, but rather it looks to set the focus on spending programs from the last package. So basically, what they're trying to do is just double down on what they've been doing, and let's dive in. The bipartisan agreement on the new package costing $1 trillion is possible between end of April and middle of May, says analyst at Beacon Policy Advisors in a note Monday. So seems like there could be no stimulus for a little while, but they're still definitely looking to add on to the CARE Act that they implemented for the $2 trillion initially. House Speaker Nancy Pelosi said in a Saturday letter to her colleagues in the Democratic-led chamber that the next bill should extend and expand the measures in Washington's Phase 3 bill, which is offering direct payments to Americans and aid to small and large businesses. President Donald Trump signed the $2 trillion measure known as the CARE Act into law on March 27th. So this new CARES 2 is basically going to double down on what they've already done, sending direct payments to individuals and small businesses who are getting affected by this COVID-19 spread. CARE 2 must go further in assisting small businesses, including farmers, extending and strengthening unemployment benefits and giving families additional direct payments, wrote the California Democrat after pulling back on Friday from her earlier calls to include infrastructure spending in the Phase 4 bill. So people are not really interested in the infrastructure. Yes, that will create jobs, but it's more on the focus of let's just get money to people's wallets, to people's bank accounts, so they can, pay for their food, pay for hopefully their rent and other necessities that will able to kind of extend their living conditions for a little longer while they don't have a paycheck. So we can read here, we must also provide the disparity needed to provide the desperately needed resources for our state and local governments, hospitals, community health centers, health systems, and health workers. As first responders and other providers are on the front lines of this crisis. I completely agree. They should be definitely getting the resources and the priority, because they're the ones putting not only themselves at danger, but they're not able to see their families. They're not able to go home. It is challenging being at home, being cooped up, being indoors, not being able to do the everyday stuff that you would normally be able to do, going out with your friends, go to the bar, go outside and enjoy the day. But these healthcare workers are away from their families, away from their kids, their brother, their wife, their spouse, or whatever the case may be, and they're working and they're saving people's lives, and they're working day in, day out to help out the greater good of the community, of humanity, and that should definitely be respected for sure. Senate Majority Leader Mitch McConnell also said the upcoming bill should be a more targeted response to what we got wrong and what we didn't do enough for. And at the top of the list, there would have to be a healthcare part of it. So yeah, definitely agree with that statement. They should be getting it more than enough in order to provide them with the best amount of resources and help that they can to continue working hard for our fellow people. Right? It's a crazy time for them, as well as the rest of the world, but for them especially, because they're the ones dealing with it every single day. All right, now to more of kind of the global macro, longer term outlook of the potential of COVID. We can see small businesses. So this is talking about rents, mortgages, all that stuff. An early poll suggests half of all businesses haven't fully paid April rent. So now that months are going by, February wasn't bad. March was when it really started amping up, and April's obviously full force into it and lockdown and really, really taking it seriously. But, people are talking summer, right? And that's multiple months of not being able to have customers, revenue, so then you won't be able to pay rent. And then that's a chain reaction, it's a domino effect of basically where is the debt going to, basically. So for example, if you're a small business owner, you have to pay your rent, and that owner of that real estate has to pay his mortgage. So then the bank isn't gonna. It's a chain reaction, right? So it's not just single individual businesses, but it's a chain reaction of down the line, where is it going to get affected here? And Alignable, a small business social networking company, says around 30% of the more than 1,000 respondents reported making no rent or mortgage payments in April, while 20% said they had only made a partial payment. So this is a large group of individuals here that are not able to pay their mortgage payments, and this is going to squeeze investors who are investing in these real estate development companies, REITs, as well as the banks at the end of the day, because those are the individuals providing the mortgages, and it's going to lead up to, okay, we can't pay our mortgage now, and if people are very, very leveraged up in a lot of rental properties, and they're expecting this money to just keep on flowing, and it suddenly stops, you still have your other end where you have to pay your mortgage. And if you go to the bank and say, sorry, I can't pay my mortgage, what are they going to do, right? And that's not one individual, that is spread across an entire economy. It's going to, in my opinion, turn from a COVID situation to more of a financial breakdown where banks are getting squeezed. Mortgage-backed securities are absolutely blowing up because no one's paying, or a lot of people aren't paying their mortgage. Investors are going to get scared because obviously if there's no money coming into the mortgage-backed security, that kind of basically voids an investment, really, because if there's no cash flow coming in, there's no point in owning it, right? So it's going to be a ripple effect, not just in one sector, but across an entire economy over a long period of time. And this is the delinquency rate on single-family residential mortgages booked in domestic offices, all commercial banks. And this is from Fred. This is the government website here. And we can see back in 2008, 2009, delinquency percentages were at almost 11.5%, almost 12%. And that was the worst of it in 2010, I guess. Yeah, Q1 of 2010 was the worst in delinquencies. I didn't know that. I thought it was going to be worse in 2009. But yeah, 2010 was the absolutely worst. And this is only in quarters, so we're not seeing any change right now. But what's going to be very significant is, in my opinion, Q2 and Q3 are going to be very, very challenging times. And we'll see how the delinquencies are doing and the percentage of them, and if they're increasing, that means banks are getting squeezed because now they no longer have the asset, right? When you create credit, someone is thinking they have an asset because there's payments coming in, but if that asset evaporates and the credit's gone, you no longer have that asset if a person fails to pay those mortgage payments. So yeah, it's going to create a ripple effect throughout the whole economy if this does get worse. But I just wanted to say that we are not going to be biased, but we also are going to tell the truth, and yeah, it's not looking phenomenal. I don't really know how to put it in a positive way. So this is the last thing we're going to talk about before we get really deep into the charts, looking at a bunch of different asset classes. Coronavirus could create a generation of super savers and reshape the economy. So just wanted to touch on this. We're not going to go into the blog post or anything, but just the idea of this definitely makes sense. If you recently started business, got fired, and are really, really having financial troubles, especially if you are in your 20s, early 30s, when you're supposed to be making leaps and bounds in your career and trying to get ahead, and you're getting absolutely demolished by this, you're going to have a different mindset coming out of this economic difficulty or economic situation that we're having right now with COVID. You are going to be coming out with it of more of a let's save for a rainy day mentality instead of let's spend and let's be consumers like a good little American like I am, because that's what the government wants. That's what central banks and basically everyone works off. Consumerism is good. It keeps the economic machine going where people spend money, they borrow, they create more money through credit. It is how the economic cycle works well in the eyes of many Americans. And having a generation of super savers is extremely, extremely deflationary. It will reduce the velocity of money substantially, because if you're not spending money, and if an entire generation is not spending money and stuffing it within their mattresses, or even worse, taking it out of banks and then storing the actual cash, that's extremely deflationary. And central banks do not like that. They like a steady, slow inflation, and deflation is not a good thing in their eyes. So what are they going to do? They're going to overreact, like we've been talking, right? What would they do? Okay, well, an entire generation is not saving. What do? You give them a shit ton of printed money and hope that they're going to spend it. And then the economic cycle would turn, the gears start getting lubrication because of the increased spending of money, or currency, I should say, not money. And then that is hopefully, in their eyes, the way of getting out of this deflationary spiral. Japan has done it, in their worst times. I don't exactly know when, but they gave money just to young individuals so they would spend it and create the economic lubrication to kind of continue the operations. And it looks like they might be doing that as well, because we've already said that their phase 4 is going to have more stimulus, more paychecks going into bank accounts, and then with a generation of super savers, it could just be this on steroids in the future. I don't know how far, but we could be seeing massive checks in, because the government is saying we need people to spend money. We need consumption to start again, because that is going to be the driver of GDP. Buying things, selling things, money exchanging hands, that is economics, and that is when you see an increase of that, that is positive economics. There's more people spending, there's more people working, there's more people earning, there's more people getting a paycheck, more money being exchanged. That's positive, right? And when you see everyone just hunker down and hoard all their cash and save and don't spend any money, that is a nightmare for central banks. And the way that they are going to combat that is to give people money to spend. Basically is my view. So not going to dive into that anymore. Hopefully you got a good understanding of what our view is. in terms of where it could go, what central banks could be possibly coming up with to try to mitigate the deflationary spiral that we are going to go into, or that we're currently already going into right now. With asset prices going down, we are seeing deflation. CPI numbers are going down, which is consumer price index, which is a good thing to look at for inflation, because it's like the value of a certain amount of goods purchased at a grocery store. So then if the value goes down, it costs less for the same amount of goods. If the value goes up, it costs more for the value of goods. And it's a CPI. It's a great thing for understanding inflation. But yeah, that is the fundamental aspect of the video complete. Hopefully you enjoyed it. Just letting you know, if you do have any questions involving the news articles we went over, anything that I talked about, anything that I touched on, definitely please put it in the comments, and I'll be sure to go over it at the end of the video. And we're now going to get into our charts here. First thing we're going to go over is gold, silver, and quickly talking about the gold and silver ratio, not really. And then we're going to end off the commodities looking at WTI crude oil. And then we're going to go into the indexes looking at the SPX, or the S&P 500, looking at both long-term or I guess the daily chart and the 1 hour / 4 hour chart, looking at smaller term and longer term time frames. And then we'll finish it off looking at the US dollar, which is going to be the strength of the dollar, and it did get a little bit of a bump up. So first off, let's now go to gold. All right, I'm going to get a little bit of coffee, and then we'll jump right into the charts here. All right, so first things first, let's get our charts here, and we should go to the long-term time frame first. I'm going to do that. Before jumping right into the charts, I just want to talk about the longer-term time frame, and then we'll jump in the 4 hour. I know we talked about it recently, but it's a Monday, and it's a good thing to go over what happened last week and what we could be seeing here. So last week, we didn't have this big green bar, so this was actually like this, and what we saw is a high and a lower high. So we connected the lower highs here, and on the 4 hour, it actually looked pretty good because the second connection had multiple touch points against the resistance, so it looked pretty well respected all throughout the chart. And also, we weren't seeing a whole lot of inflation. The stimulus package brought the S&P up, and usually when you see the S&P go up and people become more bullish on the stock market, gold is necessarily not really super bullish at that point. It's when there's more fear of the stock market and the currencies devaluing is when you really start to see gold do well. But at this point, it shot up past the previous high, which is going to be right here. So it made a higher high. So as of this moment right now, this is a low, this is a high, this is a higher low, and now we're creating a higher high from our key level of market structure, which is going to be right here. So at this point right now, we are actually more bullish than bearish, although we are right below the $1,700 level of resistance, which in my opinion is going to be something that I want to see the price pass before I look to enter long. And that's the overall structure of the daily is I have a key level of resistance around $1,700, major structural low at $1,450, and this is the zone we're currently playing with. I did draw a descending zone, but it broke above, and now, in my opinion, we have a pretty high likely chance that we're going to be testing 1,700, and it's just a matter of if we're going to break this resistance, make a higher high, and then test for a higher low. That would be super bullish, and I would be looking to potentially enter long, but as long as it's below the $1,700 zone, I don't really want to be looking for a long just yet. I would rather wait to see the price break this zone, break this key level of resistance before I look to take any longs, just because I have a higher dependability and a higher probability of the price moving upwards if I've already broken the high and respected it as a valid level of support. It just, to me, has a higher probability of it continuing towards the upside than if I enter right here. I have a key level of resistance not just once but twice, right at the $1,700 zone, and we've already seen the sellers reject the price twice off it, and we're right below it now. So in my opinion, it does look a little bit more bullish, but I'm just going to take the approach of being a little bit more conservative because we're in a very volatile time. You know, they could just put in another stimulus package and holy shit, the stock market's up and then gold's down again. Like it's at this point in time, there's a lot of fundamental catalysts, factors that play into it, and that's why we do try to do our fundamental news first, discussing stimulus packages and potential things that could affect the markets. But at the end of the day, we are going to stay back and stay patient and look for a better opportunity to enter in this market. Because in my opinion, gold doesn't serve as a trade that really gives me any edge at the moment. So if you don't have an edge, don't put any trades. Simple as that. Yeah, Truck Knobs, 3:45 Mountain Time Zone and still drinking coffee. Yeah, I drink a lot of coffee. Not like a ton, but a decent amount for sure. All right, so let's now go on to the smaller time frames. This is now the 4-hour chart, so we're going to get a little bit more granular of the detail that we're going into in the price action, but this is very important. So the 4-hour chart, we see that resistance, which is going to be red at 1700. This is going to be the main level of supply. So in my view, we're pretty close to it. So I don't really want to be looking for a long. So right now we got a resistance right here. We have an ascending support right here, and we have a descending support right here. So we are within this big triangle. Let's get our lime. So we're now within this zone. In my opinion, this is kind of like a no trade zone. I don't really want to be trading in this range. Actually, it should be red theoretically. But as we can see, I don't really want to be trading in this range because there's a lot of zones that are close, but there's nothing really broken. And there's just a lot of noise that, in my opinion, it's going to happen around here. So I don't really want to be any part of it unless it's going to give me a better opportunity somewhere else. So that's my first bias that I have within this current market structure. Now, what I would be looking for a potential entry possibility is if we hold this resistance at 1700 and then come up, and then we are able to break this ascending zone. We see as an anchor point right here. We see our first touch point. We see our second touch point. We see our third touch point right here when it broke the descending zone, which was our squeeze. And then we shot up, breaking the squeeze. The bulls were able to win the battle where the price was really at the apex, and it won the battle. The bulls took over the market, really shot up the price, breaking the market structure high, which was right here. Would not be too surprised if we retest this zone as a new level of support and then make our way back up to the $1,700 zone. So as of right now, we made a significant market structure higher high, breaking this zone. So we could be seeing a higher low, which would be back retesting the 1650 level of support. And then I wouldn't be too surprised if then we continued the momentum to the upside, hitting the $1,700 zone like so. So for the near term, that could be a possibility, and I'll be somewhat looking out for that. But like I said before, within this range is not really a trade area that I really want to be looking for. It's when we either break to the downside here and we fail to hold this ascending zone that I'd be looking for a potential short to the downside. But then if that is the case, I'd look for silver for more of a short, and we discussed that within previous videos. And then a long would be if we break this resistance zone right here and test for a higher high and break it and hold that higher high above 1700, and then we retest this zone to form a new support from the previous level of resistance. Because the market structure is already up. This is a low, this is a higher this is a high, this is a high, this is a low, this is a higher high, this is a higher low. We're seeing a test of the higher high again, which is going to test the $1,700 zone, which is a main level of supply. And then we're probably going to enter into a higher low than what we saw right here. And then we're going to go right into the apex of the pattern, which is going to be right here. And it's just a matter of, if we break to the upside, we're going to be looking for longs once we retest the previous resistance as a new level of support. Or if we break to the downside, classic ascending triangle pattern, breaking the support, and we're probably going to be looking for some short opportunities within the asset class, meaning precious metals. But I think if gold starts to go down, we're going to look for silver for a short, because silver looks more bearish. On the weekly, we're making lower highs. For silver, we're making higher lows. So looking at the weekly chart, silver looks more bearish. So then if we see gold start to fall and it looks bearish, we're instantly going to go to silver and say this is a better asset to trade on the downside. And then if it looks bullish, gold is the asset to look on the upside, in my personal view, until you start to see the speculation of precious metals increase, aka gold and silver ratio going down. Right now it's in like 120 or whatever, highest point in a very long time. Once you see the gold and silver ratio go down significantly, it's going to tell you that there's a lot more speculation in the precious metals market, and that's when you'll start to see silver go up substantially compared to gold. But as of right now, gold is going to be bullish, silver is going to be a little bit more bearish, as a directional bias viewpoint. So hopefully I gave you some insights on gold. We got two options, and I described both of them. Right now, I'm not really looking to take any trades right now. I just don't feel like I have the highest probabilities to look for a trade that has edge other than the retest right here. So this could be an option where we have a pullback to around 1643 maybe, and then we have a stop loss at maybe at 2%, and then you're looking at your first maybe a little bit higher, because I would like to have a risk reward of 2, maybe somewhere like that. So if it does pull back to our previous zone of confluence like so, probably a high probability chance. If it holds this zone, you don't want to enter right away. You want to wait until there's 2-3 injections of buy pressure on a 1 hour chart, depending on what time frame. Maybe 15 if you're taking smaller time frames, double bottoms, some level of a base hold where you see buy injections coming into the market. Then you're like, okay, A, it's a zone of confluence where I know there's a potential for high probability of buy pressures in the market, and B, I'm actually seeing the buyers enter the market. And C, look at the volume. Yes, you are seeing decreasing buy volume, but look at the discrepancy between the buyers and sellers in the market. There's literally almost no sellers compared to the amount of buyers within the market, especially where you should be seeing sell pressure. Previous level of resistance there, at that same level of resistance, you're seeing no supply candles, meaning there's a lack of supply, meaning that the demand is going to overtake the confidence, aka price appreciates. So yeah, it looks more bullish, but as of right now, it made a strong impulse move to the upside, breaking a resistance, and we don't like to enter at the completion of impulses. We like to enter at the completion of exhaustions, which is the end of a pullback. So in my opinion, the pullback that you would want to enter for the highest probability situation would be around 1635-ish. And then once you see that validation of a support, that would be a pretty high probability situation that we could capture a small move, something like this. But at the end of the day, in my opinion, this is still a lower risk situation until we get a breakout that is on a larger time frame, like the two that we've described, either to the upside or to the downside. So yeah, that's going to be my view of gold. Hopefully you got something out of it. If you have any questions, definitely drop it in the comments below. Next chart we're going to go into is silver. So this is that weekly chart, right, that we were talking about. See these lower highs form, and then it breaks the support, which is right around here. And yes, it did pull back, validating it, and it has poked its head above the previous support, which is a new resistance. But at the end of the day, I'm not going to say it's a breakout yet, because this is a zone, not an exact price area, or price line, I should say. So yeah, I'm going to be a little bit more bearish on silver. I don't really have any actionable trades for silver and gold as of right now, but it's still in the works in terms of opportunities. And if it does exponentially go up, hey, that's great. If we do see gold and silver take the quote safe haven asset characteristic that people perceive it as to be, which it is, over 5,000 years, it's been a safe haven asset. So there's a very high probability that we're going to continue to see those same properties, have those same attributes, aka gold and silver being a safe haven asset. So yeah, we're probably going to see that. But as of right now, in my opinion, it's still too early. I think the US dollar is still going to be the short-term safe haven assets for investors, as the second wave of sell pressure in the equities will come, and then more people will sell stocks, which then means more people are buying US dollars, right? If you're selling any stock, any US stock ever, you are buying US dollars, right? Because it's a pair. Equities are pairs. You're pairing it with the US dollar, same as Forex, same as crypto, but you don't pair it with the US dollar because it's already paired. Same as gold, oil, silver, all paired with the US dollar. It's a world reserve currency. So a lot of people that are selling assets are going to go into the US dollar, and that's why it's seeing so much buy pressure right now, and that's why it's regarded as the quote safe haven asset for the short term. But in my view, the central banks are going to overreact. There is going to be worry and concern for inflation, and that is when cryptocurrencies are really going to be have the shine light, or the light shine, or it's going to have the pedestal of the fixed supply asset that does not get affected by central banks printing money into oblivion, right? That is your hedge against that. So yeah, right now I don't see it in just terms of fundamentals, but in terms of the charts as well. I don't really see strong pushes, and if we do see a strong push in gold and right here, but if we are going to see this huge monetary shift where fiat currencies are going to get printed a shit ton, gold's going to go way up. So there's going to be a lot more opportunity. You don't need to catch the very, very, very bottom, right? It's not mandatory. It's just catching the meat of the move is going to be awesome in itself. If you're an investor, averaging in gold and silver, I think it's a phenomenal idea. Obviously, I'm not a financial advisor, but I think the shift is slowly happening. Not yet. It's still too early. I think that investors are definitely still thinking that the US dollar is still a huge safe haven for them right now still. But as time goes on, I do think that psychological shift will occur. But right now, still too early, so I'm not super bullish on gold, silver, and crypto just yet. In the long term, 100%, but in the short term, I think there's a little bit more deflation that has to occur before we get our surge in buy pressure for those safe haven attributes that gold, silver, and crypto share. So not much more to talk about on gold. Here's the 4-hour chart. We do see that it's holding an ascending zone, which is nice to see. We do see the resistance at around $15, maybe $14.50 as well, around that range, key level of supply. And we also see in confluence this descending zone that actually broke. So if our fundamentals were more bullish, in my view, if we saw CPI numbers increase substantially and the inflation go up, this would be pretty damn bullish, especially if we break the previous high right here and the previous high right here. That'd be pretty darn bullish in my view, but I'm gonna be a little bit more hesitant because of the fact of this major $15 resistance that we've been talking about for a long time. So that's my view. Yeah, I'm a little skeptical of a huge bull run just yet, but if it breaks 1700 and if it clears $15 without any worry and we see it go way above that, I will have to shift my bias on. I'm not going to have my bias forever, but as of right now, I'm still not convinced from the price action that we're really going to start to see that momentum to the upside with a series of strong higher highs and higher lows take the market upwards. So that's just my view. Gold and silver ratio just holding at around 110, went all the way up to 126, but now we're just consolidating sideways, and if we see it drop, that means silver is going to be appreciating faster than gold. But right now we're consolidating. All right, so crude oil, something to talk about. Last week was a huge move for U.S. oil here. Absolutely exploded. Trump said that he was going to talk to OPEC and Russia and try to get a deal for them or discuss supply, but I just think that's news. And to be completely honest, I do think that this is a pullback where there was a massive short squeeze. Look how far the price just got beaten down, right? It hasn't really formed any real pullback. That was a pullback here, but it got slammed right back down, and then it formed a base, and then this was the short squeeze. And you got a short squeeze up, and then you hit a key level of support, previous level of support, new level of resistance at around $28, and that's where we currently are right now. So what could we see from this point onwards? I'm not huge into the oil sector, to be completely honest. I've somewhat recently within this year started looking more into trading oil, but I like to look at more gold and silver personally. But let's continue on with the analysis. We do have that key level of around $28, which the price is currently holding right now below. Would not be too surprising if we do actually break that zone and get to $36-ish, which would be where the gap is. And then at that point, we'd probably be looking for some ascending trend lines to then short, because I do think that there is more bearish potential for the oil market. But just in terms of technicals, we're just seeing a nice little pullback here. We've got a nice little squeeze right here and another solid push to the upside. We're probably going to see some level of an ascending zone get created, and it's just a matter of if we're going to break that zone or not. But as of right now, it's still very early in the structure of the bullish push. We see a nice little zone right around here, creating a previous resistance into a new level of support right around there. So around $24 is the current level of support. We can see previous level of resistance back in March, which is now a resistance support now in April. So we're currently sitting at $24 as a minor level of support, and then $28 is the mid-range zone that we have within the major structure that we're currently in. And then if we do break that 28, high probability that we're probably going to be going all the way to 34, if not a little bit higher, 36, 38. But that's my view of oil in the long-term picture. Like I said before, I do think we're probably going to come back down to some degree, and then we have a good edge trading breakouts that are to the downside after the price has made a pullback, like we can potentially see here. And that's what we're going to be looking for the S&P as well. But for now, we're not really looking at trading. There's not really an opportunity that I see on US oil right now, to be completely honest. It's kind of in a mid-range zone, not really able to trade, and there's no real indications of sell pressure. If we did get another push to the upside and then we double top and then broke down with a huge bearish engulfing candle, then pull back with a weak bullish candle, testing the previous support as a new level of resistance. If we're seeing some sort of weakness and a validation of sellers, this $28 zone could just be the pullback. If we do put in our fib here, let's just get our fib and look at fib retracement. So this is the high, and then we can see the low being right there. And just to make sure, let's always zoom right in, get that candle closure on the 4-hour, significant zone, candle closure on the 4-hour, significant zone. And we can see right here, the price is basically right at the 618 fib retracement level, which is a very significant zone that we're also using for our S&P 500 trade. So yeah, would not be surprised if we do hold this zone, but as of right now, it's still too early to short. And you're probably thinking, okay, what would we need in order to look for a short in this trade? Because we've did our fib and all that stuff, we know that 618 and 50 is around here. So there's going to be some level of sell pressure because that's a key level on the retracement. So what are we looking for in my personal view? We got one key low right here, one key low right here. I wouldn't be surprised if we go like this. Zooming on the smaller time frame, it's going to be a large symmetrical triangle like so. And it's just a matter, like it's going to be like this, but this is, for example, a zoomed out version of this, and we have an edge trading this setup, right? We formed a high here, so it went like this, and it went higher, and then now we're forming weakness. We could get one more weakness, and then you usually form a pretty bearish candle right here, pretty bearish engulfing candle right here, and then you get these trickles that are slowly coming up. And then you're looking for a previous support, new level of resistance, all this stuff, all our confluence, VSA as well, and then you're looking for the bearish move. So kind of something like this would not be surprising, and then you get a little high up, and then you break, a little pullback, retesting previous support and new level of resistance, forming a lower high, creating the lower low, lower high structure to the downside, and that could be something that you'd be looking for there. Yeah, we do have edge trading potential reversals, and it forms an ascending zone, head and shoulders, or reverse head and shoulders, and descending zones for reversals from the downside to the upside. So kind of like we saw here, descending zone, you formed a very strong level of support, you broke, pulled back, and then once you break the market structure, which should be this high here, that would be the market structure break. That would be very significant, that we would have definitely our eyebrows raised. Looking at the 1 hour, not much more to talk about. Let's just draw it in right here. That's probably not the same zone. Kind of like that. That could be an option. And then we see it was a previous resistance turning into support. Let's make it a little bit bigger. Sort of like so. So then we see a push up, pull back, push, pull back, push, pull back. So then I'm sure you know what you were looking for, push, pull back, and then the momentum to the downside may start. So right now, definitely not something that is ready to take a trade yet, but yeah, it could be something that could be a good opportunity to make that extension to at least retest the $20 range to form that base and the consolidation sideways. If not, make another move to the downside, breaking that base, and then we're probably getting a lot of a pretty aggressive momentum shift here, because I'm sure there's a lot of people buying here because they're thinking it can't go lower, and that's pretty dangerous words within the markets. It can't go higher, it can't go lower. Yeah, just look at, Tesla if you're shorting. Just look at some of these cannabis companies if you are long. Yeah, they're brutal. Or some of the alts, right? Absolutely. Look at Ripple. You could have bought it at plus $3, and now it's at like 16 cents, right? So it can always go lower. It can always go higher. Always look at the price action, not the exact price, because price action will give you more information than saying, oh, it's at $100. It must be a good buy. My personal opinion. Not a fact, just my view. All right, so now looking at the SPX, this is the SPX 500 USD, which is basically the S&P 500, the largest 500 companies in the world. But this is, for me, the contract for difference, or CFDs, which will provide less gaps. And basically, I'm trading contracts instead of the actual share. I can trade half a share, quarter of a share, 1.5, and I can leverage and all that stuff. So more freedom, basically, when I'm trading. But it's more or less for swing traders and day traders. But anyways, let's get right into it. Actually, before we get into the 4 hour, let's get right into the daily first, because that is pretty important, and we are using our fibs. What did we say? We do want to see that pullback to around the 50% retracement or the 618. Around there, that is when we're really, really looking to enter our short position. Oh, excuse me. Because we already did all our back testing in the previous 2001 dot-com crash and 2008, and we came to the conclusion that the highest probability situation for us to enter short would be to find and be patient and wait for the pullback to around the 50% to 618 retracement level, where then we would look for this to serve as a key level of resistance, where we would get some reversal pattern. We would get an ascending triangle forming higher lows. When we break the series of higher lows, we'd be looking for shorts. We also saw a head and shoulders where we broke the neckline, and then we got a strong push to the downside, continuing our next leg to the downside. So yeah, definitely looks like we got some waiting to do. It looks like, it could push the upside here, but there is no way in hell that we think that we're thinking that it's the bottom. We are very, very, very interested in shorting for the next leg down, and that's going to be our bias. I do not think that this is the low, and we're going to bounce back. And for the people that are calling me super negative potentially because I do think that, you got to look at history. I'm not negative and thinking that I'm bearish because I want the economy to fail. Not at all. I'm just analyzing what I see and then trying to provide opportunities for myself and the people who are watching this video and Performante as a brand. And, if it's making money to the upside because we're longing something, or if it's making money to the downside because we're shorting it, in my opinion, it does not matter at all which way it goes. It's just a matter of how probable the situation is going to be and betting on that outcome. So yeah, basically, in my view, I do think that there's going to be two more major legs. One, which is going to be, I don't exactly know when, but I do hope that the price is going to go up a little bit, and this is going to entice a lot of retail traders thinking that that's the bottom. Like, you see people who have a large following, like Jim Cramer, say betting against the stock market, aka shorting, is betting against science, and making it seem like shorting is this instrument that no one should use because everyone should be permabulls, because economic growth should only be in one direction, straight up. And there can be no corrections, which is not true at all. Like anything, there has to be seasons. Look at seasons in like the world, right? There's winter, which is cold. It's less sunshine. People say it's a little bit more depressing. There's snow. It's cold. You gotta bundle up and it's cozy, but it's less, what you could say, I guess, happy, unless you're like a snowboarder or something, but it's less like happy and joyful than spring or summer, when things are blooming and there's life everywhere, the sun's shining, it's warm, the grass is super green. There's ups and downs in any cycle, business cycles, seasons, personal life. If your life is a straight line trajectory, that's pretty boring. You're not going to know the highs and how happy you are, how thankful you are that you have food on the table, or it's someone that you love very much, who cares about you, or you're able to provide for yourself, or you got out of anything, like typical situations, whatever they could be. But you see the cycles and you see the downs, and then you get out of it, and then you get the highs, and you look back and reflect and go, wow, I really got myself out of that one. And that builds character, and that builds self-respect, because you see the shit you went through and you're like, wow, that really made me a lot stronger than I would have been if I didn't go through that at all. And what a lot of people are hoping is there's just no economic downturn. There's zero. And that's impossible, right? And, with these permabulls saying, this is the bottom, look at 2001, look at 2008, and see how they went down. It is a lot more clear looking at the weekly and daily chart, looking at 2001 and 2008, and really just sticking back and just looking at the chart instead of going every day and listening to people say it's bullish, it's bearish, it's bullish, it's bearish, and confusing your brain, because it's very difficult, right? People saying the coronavirus, the entire pandemic is now priced into the stock market. Yeah, you're going to believe that. I personally have no hope that it's priced in right now, even at these prices, in my personal view. There's 10 million people that applied for unemployment within the first month of March, or 2 weeks or something like that. But 10 million people, right? That's more than 3% of the entire fucking population of the United States in such a short amount of time. Completely wiped out from the economic workforce. That's substantial. That's not something to just bounce back from, in my personal opinion. So, yeah, I do think it's going to get worse. And that provides an opportunity for people, for those who are not very active in the markets. Yeah, if you're just holding 401ks and doing absolutely nothing other than just sitting at home and having no involvement in any financial markets, it's just going to suck, because you're going to lose value in your assets if you're just holding your 401k or long-term investments. But if you're more active in the markets, this provides a tremendous opportunity, because let's say it takes 5 years to invest from, let's say $100 to $150, right? Let's say a long time, right? In that same distance, to get from $150 back to $100, it could take maybe, 4 months, 6 months. So the amount of, volatility, it's more risky, 100%. It's way more risky. But the amount of opportunity that is available in these volatile markets is in such a compressed amount of time that you're able to escalate your net worth, your portfolio value, your social standing, if you're really looking at it in that terms, quite quickly, because you see these massive shifts. So, this is the first one. I do think there's going to be 2 more. And looking at, TVX that can go from $200 to $1,000 in 2 weeks, or shorting this, looking at how far it went down, looking at the risk reward parameters that you're looking for in these trades, you're able to provide some awesome opportunities. Trucknub says, lol, at the moment I've made more money shorting than going long. Yeah, see, the opportunities are there, and if you have been putting in the time to understand basic TA, understand basic risk management. Not saying, I'm going to short this and I have no idea when you're getting out. No idea what your stop loss is or your take profits. That's not a good trade. But if you have a system, an approach, a systematic way to approach the markets that you've been testing and implementing in real life situations for a while now, you are in a really good position to potentially take advantage of this very, very aggressive move that we're going to potentially see. Like always, not financial advice. This is just what we're seeing in the markets and what we're planning on doing, and how we're going to position ourselves to kind of try to take the most out of this opportunity. And that's how we see it right now. So yeah, that first leg, definitely, that is the indication that yes, we're in a bear market for sure. But this next leg, in my opinion, is where there's the highest dependability for another leg down, and it's going to be more aggressive. So yeah, I'll keep everyone updated. As time goes on, I will kind of wind off from just posting these on YouTube, because I do want to provide this opportunity for Performante Premium members kind of only to some degree. I've been talking about it for a very long time, but I do respect them immensely, and I really, really cherish them, being a part of our list and our group and our community and everything that they are involved with. So huge appreciation for them, and that's kind of why we're going to try to wind off a little bit and provide the utmost amount of value we possibly can to our Performante Premium members. So that is the completion of the global macro update. We didn't really get into TVX too much, but we talk about it very often. The dollar moving up a little bit, but like I said, that $103-ish range is going to be the key level that we're wanting to see break in order for the US dollar to see a surge in strength again. And we're right now in a bit of a consolidation, but I would not be surprised if we saw another move up, breaking the resistance, as we can see on the weekly chart. So that is the basic completion of the global macro update. We really hope that you enjoyed this video. If you do have any questions, drop them in the comment section below. I do these live on TikTok and YouTube every weekday, and if you do want to catch these live, so you can answer, or so you can ask a question and I can answer. We do them every day in the morning, and then the global macro in the afternoon Western time. So definitely check that out. And I'll be going over all the questions on the TikTok, but I will close the global macro update right now. So thank you very much for watching, everyone. And until next time, happy trading. All right, so that is our global macro update complete. I just stopped the recording, so I'll go over all the questions that are on YouTube, which there really isn't any. Truck Nubs, thank you very much for being a part of our YouTube live again. Love hearing that you've made money going short, being very dynamic, flexible with your trading system and adapting to the different market conditions. Congratulations, huge respect and shout out to you for really trying to take advantage of it and doing your homework. And yeah, I respect and commend that greatly. So nice one on that one. And then now we'll go into the TikTok comments here and try to explain some things that maybe people were unable to understand or anything. If you have any questions and would like to ask anything right now, definitely join in and ask a question in the TikTok comments. So I'm going to go over them right now, and then that'll be the end of the global macro update. Mr. Canodog Life, what's up, man? How's it going, Mr. Canodog Life? Got a lot of people joining, which is great to see. Let's see if there's any comments here. Riot moving. Yeah, Riot is a equity that is involved in cryptocurrencies. I believe they're a mining company. I used to trade stocks related to cryptocurrencies, but now I just trade crypto. But yeah, Riot's, Mara, Dash is all three companies that are related to cryptocurrencies. So yeah, if BTC and cryptocurrencies are getting more bullish, those are some of the equities that you could invest in without actually having any involvement in cryptocurrencies or digital assets. You can own equity of companies that are providing services or mining cryptocurrencies or Bitcoin or whatever. Dash is mining. Dash, they have a huge mining pool, which is called Neptune Dash. They're actually located in Canada. Riot, I believe, mines BTC. I don't exactly know. Mara, I believe, also mines BTC as well. All right, so is this BTC? No, it's a company that I believe mines or is involved in cryptocurrencies. So Riot is an equity. It's a share of a company that's involved in cryptocurrencies. Mara, M-A-R-A, is another one, and Dash, D-A-S-H, is another one, and they're called Neptune. That's Neptune Dash. Good opportunities if you are trying to get exposure in the equity markets involving in cryptocurrencies, but don't actually want to dive into cryptocurrencies. Options. LOL. Let's look right here. Can you take a look at XSPA? He says, I jumped into it to chase. Shouldn't have done it, lol. No. You never wanna FOMO in. Okay, sure, let's look at it. Let's look at it. Just for you, Mr. No Thumbs. Hopefully you have thumbs because you're texting and messaging. All right. XSPA. Let's look at this here. So this is Expressa Group Inc. Got the, hopefully you can see it here. Let's go to the daily chart. Wow, that's, let's make it bigger. Yeah, that stock's really fucking beaten down. Wow, something happened here. Huge fundamental news. So you were long, I assume. So you bought. I personally don't think that would be an awesome idea. Just looking on the weekly, look at the very, very clear lower highs and lower lows holding a descending trend line. Making a descending zone here. So, you know, the higher probability situation probably would have been to wait until this descending zone broke, so you have some level of a shift in trend. Got in at 31. Okay, let's get our 31-cent range with this right here. 31. All right. So I'm just looking at major zones just because I want to know where my key zones are before I dive into the smaller time frames. All right, so I understand the large time frames. Let's now go to the 4 hour. You got in at 31. Okay, well, you do have a base at around 14 cents. So if it goes below 14 cents, probably wanting to maybe think about getting out. Obviously, you have your own bias that you want to go into. And it wouldn't be that crazy of a loss, right? Looking at... Oh, shit. No, never mind. That's really bad. Yeah, that would be the low. But what we can see right here, hopefully you can see it a little bit more clear. I see some similarities with the support that we're holding here. So it's kind of forming, obviously, lower lows and lower highs. But you can see that this is a low, this is a high, this is a lower low, this is a lower high, this is a lower low, and we could see a lower high here in my personal view. So if it does hold above this support of, let's say, 15 or 14 cents, like we've seen here, it's forming a solid base, which is good. It's forming a solid level of support where buyers are not able to put the price down, like we've seen right here. Strong level of support, right? And then what happens after we see a break in the consolidation? We form a series of higher highs and higher lows, which is really good. And then we make a strong push to the upside, and that's a very significant move. It went from, like, let's say 65 or 70 cents up to $1.10. That's a huge move if you're trading with some size. So looking at what happened at the end of December and start of January, we can see, okay, well, if this is going to happen again, we see a strong level of support like we saw last time in that consolidation zone, and now we're seeing a nice strong level of resistance at around 40 cents. So now, in my view, we're just consolidating right here, holding a resistance and a support. So hopefully you can see it. So the structure that I'd be looking for is I ideally like to see the price break out of this consolidation sideways, form a series of higher highs and higher lows, and then just trail your stop loss until the price breaks a major level of support. And then that's basically how I personally would be looking to trade this particular situation. Or you could just look for horizontal zones of supply and demand that we've seen in the previous time frames. That's also an opportunity that you could be looking for. But at the end of the day, you entered at the mid-range zone of a consolidation, which isn't bad. It's not a bad entry. Ideally, you're looking at a little bit lower, but yeah, I think it could pull back a little bit here. The S&P is also going up a little bit, so you have a little bit more sentiment in trend, I guess, to some degree, but yeah, I'd be pretty cautious because the overall momentum is very to the downside. I wouldn't be too greedy with this. Also, the fact that you see a lot of gaps here, so you want to be pretty cautious depending on how much size and what the level of risk you want on this trade. So yeah, I have no idea what your risk parameters are or anything, why you entered, where you're getting off or anything. But yeah, if I entered exactly where you entered right now, I would have a stop loss below, let's say, the previous low of like $14 or 14 cents, sorry. And then I would look for the structure to shift to form a series of higher highs and higher lows before I look to sell, maybe before hitting that trend line here, because it's kind of looking right now like it could kind of form that slow L shape hold and then a slow series of higher highs and higher lows before you get an ascending trend line and it breaks and you get that massive down shift yet again. So yeah, we will see. Let's look here. So yeah, hopefully I gave you a little bit more perspective as to where you entered, what I would do. I'm not saying you should do any of this. Just think of it as asking a complete stranger that you have no idea who you've met before. We are not financial advisors, and this is just our 2 cents and our personal opinion. Do not take it as financial advice. If you are actually in need of assistance, definitely talk to your financial advisor and not a random person on TikTok. This is completely an opinion, not a fact. All right. Okay, that puts some thoughts to rest. Well, hopefully you're not using our view to make your choices. Hopefully you're using your own understanding of the markets, and our explanation is just giving you more validity, I guess. Can you look at silver? Sorry if you have already missed it. Hello, Christian. So we already looked at silver today. I will be posting the global macro update talking about both gold and silver, what my views are, and what some potential opportunities are going to be within the global macro update, which we will be posting in our high quality analysis, which is within our Discord. So right here, every single day, weekday I should say, we post a crypto market update because we're mainly cryptocurrency traders, and we post a global macro update, which is going over gold, silver, SPX, long-term, short-term, TVX, all that stuff. So more global macro stuff. Also looking at some fundamental information that is pertaining to what we're trading. So yeah, if you haven't checked that out, definitely check that out. We're not going to go over an entire analysis on silver, but if you are interested, head over to the Discord and we will have it up shortly. I'm going to close this live once I complete all the questions. I'll timestamp it, make the cover photo, and then post it on YouTube, and as well as post it on Discord. So you'll have it very shortly. And we're looking at 4-hour error charts, so it's very actionable types of analysis that you can use. All right. Mr. Thumbs, I should not have gotten in. Yeah, it's definitely hard to have stable emotions in this market. I get what you mean. It's not sometimes it's sometimes very challenging. It was a news play. Yeah, totally understandable that that could happen, I guess. The volume though. Short smashed it hard. Yeah, they definitely did. Yeah, thanks. No problem. Definitely, in opinion, greater than I understand. Okay, wow. Thank you very much. I just wanted to hear your thought process on it. Yeah, I am. Okay. Yeah, I think that's the end of the videos here. Probably going to close it off here. We have no more questions. Oh, we got a question from Evan Green on YouTube. Also, if you have any questions on TikTok, YouTube, definitely post them now. Yeah, we'll be happy to answer any ones that are pertaining to what we're talking about. From Evan Green, on average, how often do you make trades, and do you think overtrading is a problem? So your first question, on average, how often do you make trades? 25 to 35 trades a month, probably. Depending on the month, obviously every month is different, and it's not like we are going to have an exact count on each month, but if it's a little bit slower, we'll trade less, but on average 20-ish to 25, maybe to 35 trades a month. Maybe one a day, a little less than one a day, maybe a little less, but recently, yeah, it's been around that. And for how long, I don't love short-term day trading. I'll rather swing trade. So I look at 1 hour, 4 hour, do multi-day trades. For example, on Bitcoin, we've been holding this long since 5 days ago. Yeah, so quite the swing trade for sure. But and we haven't actually. We're probably trading less now, to be completely honest. But let's say 20 to 35 trades. I know it's pretty broad, but if there's not a lot of opportunities in the markets, we just don't trade that much. And if the market presents itself with a lot more opportunity, we will trade more often. But yeah, 20 to 35 trades probably on average on a longer duration, like a year, looking at how often we trade on a monthly basis. And we look at 4 hour, 1 hour as our primary source for our market structure for where we're looking to enter, potential price action patterns that we're trading, and all that good stuff. So yeah, that's how often do I make trades. So around there, I take what the market gives me. And how do you think overtrading is a problem? I think overtrading is a very big problem for people who are unable to have discipline and be able to follow a plan. When I first started, I initially started trading short-term time frames in stocks and equities and ETFs, and in just like more biotech stocks like phase 2, phase 3 catalyst, biotech or life science equities that are like more low cap, high volatility, low float, all that stuff. But yeah, I definitely understand how overtrading can be a problem. And I think the only way to learn it is through failure and then reflection. And then you see that overtrading is not. I can tell every single person who's a Performante Premium member, don't overtrade. If you don't see a setup that day, don't take it. If it's a B minus C setup that you don't really think is a great opportunity, but you still kind of want to trade, go open a paper trading account and have fun, because our goal as a trader is not to make trades. It's to find the highest probability situations that the market is going to provide us, and then act on those and manage it in a way that is systematic, that is in line with our trading plan that we've already implemented. That's our goal as a trader. Our goal is not to make money every single day. Our goal is to become an awesome trader by following a plan, have a plan that works, always try to improve the plan, and take action when you need to, and the money will follow. Because it is, if you think about the money, if you think about, I need to make a $100 trade today, I need to make a $500 trade, whatever it is, if you need to make a $10 trade today, you're going to think about it, and you're going to force trades, and you're going to be like, I need to make $50 today to cover my losses I made this morning, and I need that $50 back, or need that $100 back. That's not the right way to do it, because you're going to force trades. You're going to be like, well, that's not a great symmetrical triangle, but it looks like an opportunity. It's going up. We're seeing higher highs and higher lows, but it's not perfect. It's not ideal for me. And those like iffy trades is what, in my opinion, what separates a lot of the break-even traders from the profitable traders. Is just taking out those bullshit unnecessary trades will give you so much more profit at the end of the month, because you're not spitting away like 1% there, 1% there, 1.2% there, 0.8% there. And like, it doesn't seem like it adds up until you look at your P&L for the whole month and you see 4 or 5 trades that you took that you shouldn't have taken, that equate to 4 or 5% of your profit of that month, right? And that's a huge amount. Like if you're trading a decent size, you like 10% a month is a good decent month if you're trading large size. And if you can trade more, that's phenomenal. You also have to consider the risk that you're putting on to make that 10%. Like if you're risking 1% of your total account, you're going to make less than a person who makes who trades 3% of their total account on each trade, which makes sense. It's more volatile, depends on how much volatility you want within your portfolio. But just taking away the bullshit trades will allow you to really save that capital and preserve what you made with your positive trades. And it's not easy to do, right? There's always going to be uncertainty. There's always going to be that level of uncertainty when you're trading. You're never going to know, yes, I'm so confident this is going to go down, up, that I'm going to put all my money in it because I'm just so confident. If you're that confident, I think there's a problem. There's always going to be some level of uncertainty. That's why we set stop losses. That's why we set max percentages that we're going to lose. If we were 100% certain, we wouldn't need to set a stop loss, because if the price wicks down, it's okay because we know it's going to go up. And we don't have that guarantee. It could continue to go further and further down. And we need to have a system in place that if it does do that, we are going to get limited with the amount of losses that we're incurring. And that's why we have stop losses. That's why we have managing risk rules that allow us to fight another day, to trade another day. And basically, that's what it's there to do. So hopefully I gave you a little bit more insight as to over trading. I do think it's a problem for a lot of people. It was a problem for me when I first started. As time goes on, you realize how detrimental over trading is to your account, and it's adapt or die. As a trader, you either have to adapt through pain and suffering and then reflection, and you see all the damage that you were causing, both psychologically and to your portfolio and your account, and you say to yourself, I cannot do this anymore. It's either I continue to do this and I feel the pain, I feel the suffering of me putting on bullshit trades, wishing I wasn't in them soon after, or I tell myself, I force myself before I enter a trade, do I really want to do this? I look at myself in the face, I quickly look in the mirror and say, do I really want to enter this trade? Is this an emotional trade? Is this a FOMO trade? Is this a trade that I really am proud to enter? And that's what you have to ask yourself, right? You know when you're proud of entering a trade, even if it doesn't work out. Like for me, I'm more proud of the trade I entered than the actual outcome. And it's weird to say that. But if I put on a shit trade and if it actually goes my way, I think, well, that was really lucky. But I shouldn't have made money there. That was rewarding me for bad behavior. Whereas if I have such a perfect prime situation where I'm like, holy shit, this is like a really good opportunity in my eyes. And if it still goes the opposite way, and if I lose money, that opportunity, I'm happy I took that trade and I didn't back out, because looking at my backtesting that I've done over, months and months of backtesting, if you're going to do that, looking over your statistics, on a statistical basis, over a series of 30 to 35 trades on your sample size, you will make money on that. You know it for a fact, right? Unless the market shifted in the time that you backtested to then what you know now, over a series of trades, if you take that trade every single time, you have an edge. You don't have any edge over a single trade. You can't guarantee you're going to make money over that one trade, but you can sure as hell bet the bank that you're going to make money over 30 trades if you take that trade every single time, because you know how to manage it, you know how to take it, you know when to take action, you know when your stop losses, you know how to take profit. You've done it over and over and over and over and over again to a point where you understand that setup so fucking well that you know you can extract dollars from it over a series of trades. It might not be one trade, but over a series of trades, you can extract that money from the market with that setup. So just wait for those and leave everything else aside, because the less trades you take and the more size you put on the trades that you have a high probability of being right, that's when the bigger money starts. Is when just sizing up on the trades that you have a high probability of taking, and then cutting out all the bullshit in between. And I know that for the people who actually actively trade, what bullshit smells like and what a cupcake smells like in terms of what a trade potential is. And if you don't, you better know, because that is what's important as a trader. A little bit of a tangent, but I hope you got a lot of value from that, Evan Green. Definitely overtrading can be a problem, and I hope you got something out of that. Candy SST, should I go all in on Tesla right now? That's 100% up to you, my man. I'm not going to tell you what you should or should not do. I wish you the very best in your future endeavors, whatever you choose to do. So that is the completion of the global macro update, and we will post this on the Discord. Thank you very much for everyone who posted or commented a question or whatever and engaged with us. We really do appreciate it. Our goal as a brand, as a channel, as a Performante team really is to provide information in a way that is digestible and actionable. And I feel like people are slowly recognizing that our goal is to do that. You know, like, we're really trying to help out here because I know that there's a lot of people in economic turmoil, and not help out as in, like, you know, we're going to tell you financial advice and we're going to set you free. No, it's like, I know a lot of people that don't really understand what's happening, and having someone who's active in the markets every day, bringing you information on what's occurring, is pretty powerful in my opinion. And we're not saying that we're right, you're wrong, this person's wrong for doing this. We're not saying any of that. You know, follow your own opinion, follow your own knowledge and intuition and due diligence. You should be the captain of your own ship, right? Like, it's great to get other viewpoints because then you can construct your own thought process. But at the end of the day, you shouldn't be saying, "Oh, Keith said ABC, so I'm going to do ABC." And you look at the facts itself and say, why is he thinking that? Okay, well, let's look back at what he said before. Okay, now I know why he's thinking that. Okay, do I jive with it? Do I agree with what he's saying? If it's a yes, well, then you're not agreeing with me, you're agreeing with the facts. You're just on the same page as I am. So you're not agreeing with me just because he said it, but you're agreeing with me because you've looked into the information, the same information I looked at, but then came to your own conclusion. And that's why you're doing what you're doing. And that's our goal. And if you come up with a different conclusion, that's great. I applaud you for doing your own due diligence and having a different opinion than me. Right? But that's our goal. Let's look in here. Candy SST, I'm not a man, I'm a female. Did you just misgender me? I did. Shouldn't have, what's it called? Assumed gender. Yeah, it's definitely a thing right now. But, yeah, thank you very much for man name Candy SST. Lol. Yeah, there's some weird people out there, man. I have no idea. Candy could be a name. Or Dist? I don't know. There's a lot of ways to say names, right? But could be a gay man who really likes candy. You never know. There's a lot of different people in this world, and not to discriminate, but should have said he or she is less desirable than you or that individual, I guess. But anyways, that is the end of the Global Macro Update. If you have any questions, definitely post them on tomorrow's video. I thought I definitely went over some good questions, and hopefully that was able to answer some blanks for the individuals who did ask them. So thank you very much for the engagement, and you can find this video recorded in the Discord that we mentioned in this video. So until next time, have a good one, everyone.